Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights. And this is the second half of Chapter 6. We're looking at time value of money, where we have multiple cash flows over multiple periods of time. We're looking at things like annuities and perpetuities and various types of loans, including amortized loans. All right, so we're going to pick up on slide 30 if you're following along with the slides on your own machine. So let me just switch over to the slide deck and I will get out of your way and let's go. All right, so here we're talking about the future value of annuities. When we ended part 1, we're looking at present value of annuities. A future value of an annuity might be an example where you're investing while you're in your job, and at some point later on you will retire and you'd like to know how much money you will have at the end of that period of time. Or maybe you want to know how much you have to, at what rate you have to get in the market to retire with X number of dollars. So all of these things are something that we would do with a future value of an annuity. Notice here's the annuity future value factor. Looks very similar, but instead of 1 minus 1 plus r raised to the t, it's 1 plus r raised to the t minus 1. Now, in this example, they're saying we're going to contribute $2,000 every year to a retirement account that is paying 8%, and we're planning on retiring in 30 years. How much will we actually have? Now we can plug and chug, 8%, 30 years, there's 8% again, calculate the factor, multiply the payment by that factor. So here we are doing that. And that means that we'll have about $226,000 some dollars if we did that. Probably not enough to retire on, at least not comfortably. So hopefully you've got Social Security, hopefully you've got maybe a defined benefit plan as well. Let's look at how do we do that with the calculator. And need to clear work. And so we're going to have $2,000. And that's a outflow, so that's a payment. We are going to zero out the present value because we're assuming we start with nothing and the first payment is 1 year from now. If we did have something in there, we could just put that value in the present value. And again, we'd want that to be negative since we put a negative into the payment. So these are all cash outflows into the retirement account. 8% is our return, and so we're also doing this for 30 years, so that's our N, and now we can compute a future value. There's our 226,566 and 42 cents. In this example, they're looking for a rate of return. They don't actually end up calculating it for us. They just tell us that it's less than 1% monthly. And there's also some interesting information embedded in here from a historical perspective, that if you look over the period from 1925 to 2022, and you look at 25-year spans of time, contiguous spans of time. So we start with 1925 to 1949, 1926 to 1950, and so on. We look at all of those periods of time. We look for the worst return over a 25-year span. That would be from a period of time that ends on December 1978. And if we had put in $100 per month over the entire 25 years, I think that's 300, is that right? Yeah, that's 300 months. We would have ended up with $76,374. So the question is then, what was the return that we were getting from the market in this worst 25-year span? And they go down and do some trial and error to get that it's 1% is too much. But let's plug in the numbers into the calculator and get an exact figure on this. So we have, clear it, $100, and that's a negative every month. And we are going to zero out the PV. We're going to do this for 300 years. All right. And the future value was 76,374. So 76,374. And plug that in. Now we compute I. So it's considerably less than 1%. It's actually 0.55%. Now, if we look at that on an annualized basis, times 12, that's only a little over 6.5%. That's the worst that the market has ever done since 1925 up till 2022. 23 and 24 have been pretty good, so I don't think that would be there would be anything worse than that one period of time from 1953 to 1978. In some regards, that should be comforting, in that historically the worst market for a 25-year span has only been 6.6%. In another sense, it's troubling. But remember this: the reason that this is important is that while we do these averages and things of that nature, when we look at returns and we say, well, on average it's 9%. Well, but here's proof positive that there was one span, an entire 25-year period, where the market averaged only 6.6%. And if that's the span of time in which you were investing and you were hoping to retire, you didn't do so well. Now, there are other periods where that 25-year span might have been 7, 8, 9, 10, 12% or more. But you didn't live through those periods. You weren't trying to retire over that span of time. So when you are getting to that point, it's very important that you talk to your financial planner and make sure that you're putting a sufficient amount of money away. Now, hopefully this span of time, I don't recall exactly what the individual annual returns were in the market over that span, but if you had some bad returns early on, you would have some time to correct it by inputting more money into the market. So instead of putting $100 a month, maybe you put 150, or maybe you put 200 in. That probably isn't going to change your life that much in the time span when you're investing, but it could very well change your life later on when you're trying to retire. All right. So not only is this a good example, but it also helps us understand what the riskiness of the stock market. It is quite risky. This is a note about a different type of annuity. There really, we haven't mentioned this yet, but there are really two types of annuities. There's what's known as an ordinary annuity, and that's what we've been working with. An ordinary annuity is one where the payment occurs at the end of the period. An annuity due is different than an ordinary annuity in that the payment occurs at the beginning of the period. Anybody rent? What kind of annuity are you paying when you're a renter? Yeah, right. Annuity due, because you're paying at the beginning of the month for the rental during the rest of that month. So a rent contract is actually an annuity due. Now, what difference does this make? Well, it makes a fairly big difference when we're trying to figure out one versus the other, which one might be worth more. Well, if we had the same, let me go to the blackboard here. Let's say that we had an annuity And I'm going to put in, I don't know how many years here. Let's do 7 years. Okay. And we've got one annuity. It pays $10. And this is our ordinary annuity. Then we've got another annuity. And this is the annuity due. All right. Which one of these annuities would you pick? If you got to pick either one of them, and the riskiness of each of them is identical to the other, which one is more valuable? One or two? Ordinary or the annuity due? What do you think? No, you don't need to get out your calculators. Let me show you a little trick here. All we really need to know is which payments differ between these two investments. Okay, we've got these payments are identical. Let me change the color here. These payments are identical, identical, identical. It's this payment and this payment that differ. Now, can you tell me which one you would pick? Would you rather have $10 today or $10 in 7 years? Of course, I'd rather have the annuity due. In this case, the annuity due is more valuable. In fact, in every case where the cash flows are the same, the riskiness of the annuity is the same, an annuity due is always worth more or more valuable than the ordinary annuity. Now, that's not to say that one is better than the other. It's just that the convention say when you rent is that it's always a annuity due. Many times when you think of an annuity that you're buying for retirement, it may end up being an ordinary annuity instead. But just know what you're buying. It's like I say, it's not a huge difference, but it can make a difference when it comes to valuing these things. Know what you're valuing, whether it's an ordinary or an annuity due. Oops. All right, so let's get back out of that. All right. So, in summary, they just go over the terminology and the notation. The future value of an annuity here is this, and there's that formula. And then once again, you'll have these on a formula sheet, so no need to memorize them. And I don't require that you actually use these formulas. You can certainly, and I would expect that most of you will use a calculator with the TVM functions built into it. And here are the rest of the formulas. This would be the present value for an annuity. And then this would be actually a bit of a preview of where we're headed next, which is a perpetuity. It's basically an annuity that never ends. In fact, it's a series of payments with an infinite life. So the formula there, the present value of a perpetuity, is simply the periodic cash flow divided by the rate, the riskiness of this. All right, so this is where we're headed to now. Sometimes these go by different names in different countries. In the U.S., though, it's known as a perpetuity. We can also have a growing perpetuity, but in the case of just a perpetuity, it is the constant payment, same payment, period after period after period, forever. Now, the interesting thing about these is that this is a closed form solution to an infinite series. And what you'll find is that payments beyond, say, 30 periods out, especially if we're talking in years, they become very, very, very small, and they become almost meaningless. We could do this in a spreadsheet, and I could show you that if we go out 30 years versus 50 years, the amount of the difference in the present value of between 30 and 50 is very small. Between 50 and 100 is even smaller yet. So while it is truly forever, the value of it is actually based upon really the earlier part of the payments. So here's an example. If we have a perpetuity of $500 every year, and the riskiness of the cash flows is 8%, what's that worth today? Well, somebody would be willing to pay $62.50. Now, let's see what we get if we do this same thing as an annuity for, let's say, 20 years, and then 30, and then 40, and then 50. So remember this $62.50. That's our target. Now I'm going to go over to the calculator here, and I'm going to do 500 is our payment. I am going to zero out the future value, and I'm going to put in 20 years, and I'm putting in 8%, right? And so starting here, okay, 4,900. So that's considerably less than 62.50. Let's go 30 years and see what we get. Remember, that was 4,900. With 30 years, it goes up to 5630 almost. 5630. So we're up a good bit. How about 40 years? 5962. Oh, we're getting very close to 6250, aren't we? 50 years. 6116. There's less than, what is that, $134 difference between this, a 50-year annuity, and a perpetuity, which has a theoretically infinite life. It's only $134 difference between those. If we go to 60, 188, 6188. You get the idea. The further out let's go to 100. Oops, don't want second. I want that as N, and I want to compute PV. 6247. Only $3 worth of that. There's only a $3 difference between the perpetuity and a 100-year annuity. So you notice that these things converge. We could go to 150 years. And that's going to be 6249.93. Right? You get the idea. So anyway, that's an annuity. Preferred stock is an example of an annuity. So in this example, the question is, we have Fellini Company, and they want to sell preferred stock for a price of $100. There's a similar issue that's selling for $40 per share that pays a dollar dividend every quarter. And if we use that, we can use that same rate that's paying, the effective rate, and apply that to the $100 stock that we'd like to sell, and determine how much the dividend needs to be in order for investors to pay us $100 for a share of preferred stock. So down here, we're doing the calculation. We've got $40 here in terms of the value. Here is the cash flow, and we're dividing it by R. In this case, we're looking for R, so we leave that as the unknown. We shuffle things around a little bit, and we find that R is 2.5% or 10% annually. So if we do that same computation here, put $100 over on this side, now we know our R, we plug that in, and we're looking for C, and we find that C is $2.50, or 2.5 times the amount of the dividend for the $40 preferred stock. If we pay 2.5 times that dividend, that will give us a stock that should sell for $100 per share. All right, now we get into this concept of growing annuities and growing perpetuities. The big difference here is that there's going to be a constant growth rate in the payment. So instead of being a constant payment over time, that payment is going to grow at a predetermined rate over the life of the annuity or the perpetuity. Excuse me. What's that do to our formula here? Well, the big difference here, especially when we see the perpetuity, is in the denominator. Instead of just dividing the cash flow by R, we're dividing it by R minus G. That's going to result in a smaller denominator and, of course, a larger value that we get out of that formula. In the case of an annuity, this numerator gets a little ugly, but you can think about this intuitively. Here's the way I like to think about this. So we've got 1 minus the 1 plus g over 1 plus r raised to the t. So, oops, meant to go to the blackboard here. Okay, so we got 1 minus 1 plus g over 1 plus r raised to the t. All right, and that's divided by r minus g. Or we could break that out as 1 over r, oops, my bad, r minus g minus 1 plus g over 1 plus r, all raised to the power of t, and divide that by r minus g. All right, so the way I like to think about this is that this piece of it, this is a perpetuity. So from here out to infinity, we're going to get whatever C is. You get the idea. Now, this piece of it right here, so let's say the annuity ends out here at year 10. All right? And so the value of the perpetuity is for this entire span of time, going out to infinity. And this piece of it, we're subtracting off this times, remember, this is, all of this is times that cash flow. So we could plug that in here. So here's year 10. So effectively what we're doing is we're getting the value of the entire perpetuity, and we're subtracting from that the value of a perpetuity that starts 10 years from now. And that difference right here, that is our growing annuity. Okay? So at least, even if you don't have any sort of algebraic proof here, you've got some intuition as to what this mess is over here. Let's see. They just show how to plug into this thing. And we could do this. We don't necessarily need a TVM or a financial calculator to do this. We could simply plug this into any old regular calculator and get the value of the perpetuity quite easily. The value of the annuity is a little more difficult because we have to deal with this animal up here. It's not that bad, really. I mean, you're just doing something like 1.05 over 1. It should be 0.11. That should be a point in there. And raising that to the 20th power. So make sure you keep your order of operations straight and so forth. But if you do that, you should be just fine. So now we move into talking about APRs and EARs. Now the EAR, the effective annual rate, is really the gold standard here. APR is not the actual rate that you receive or that you pay, as if the compounding period is other than a year. If the compounding period is a year, then APR and EAR are the same. But if the compounding period is less than a year, then EAR is always higher than APR. Just a little sidebar here too about the government and regulation. I'm a firm believer that we need some sort of regulation in our financial markets. The problem, though, is that much of the industry has input to that regulation too, and they're trying to make sure that they can make the most money they possibly can. When it comes to you and I borrowing money, you get a form, and that form is going to be the same form every time because it's a form required by an act of Congress. And you're going to be told things like, what is the APR in this loan? You're going to be told, what is the total repayment? You're going to be told, what's the total amount of interest that you're going to pay, etc., etc. The one thing that's on that should be on that form that is not on that form, EAR. That is not on that form. Why is that not on that form? Because industry got in the way and said, no, we don't want that on the form. Kind of defeating the purpose of that form. The purpose of that form is to make sure that customers are completely informed about what they're signing away. And the fact that effective annual rate of return is not on there is just obscene. It's absolutely ridiculous. But anyway, I'll get off my soapbox now. Let's go back and talk a little bit more about the difference between these things. So we have a quoted rate of 10% and it's compounded semi-annually. This means that the investment actually pays 5% every 6 months. So is that the same thing as 10% per year? And the answer is a resounding no. So here's how it works. So if we invest $1 at 10% per year, we'll have $1.10 at the end of that year. If we invested that $1 and it was compounded every 6 months, with 5% being paid each period, then that would actually give us at the end $1.1025. This actually is incorrect. This should be 1.1025. That factor should be 1.1025. And that, where do we get that? Well, it's 1.05 squared. All right. So that extra 25 basis points, by the way, a basis point is 1/100th of a percent. So I could say that 1/4%, or I could say 25 basis points. So it's an extra 1/4%, which is not trivial, really, especially if you're borrowing. Might mean your payment is considerably higher than an alternative. And if you didn't know, you would just be looking at APR and not looking at the compounding, how many times it's compounded per year. You might make the wrong investment. And we'll have an example of that here in just a minute too. Anyway, so that's a simple example of effective annual rate. Here's the example that I was just mentioning. We've got 3 banks, A, B, and C. They have APRs of 15, 15.5, and 16. Now, if we weren't looking at compounding, we would pick Bank C, right? No reference to the artist in London. But if we do have compounding, and depending on whether we're borrowing or lending, we might pick one of the other banks. So let's see what's going on. Well, remember what I just said about if compounding is annual, APR is equal to EAR. So in Bank C, the EAR is 16%. Bank B, because it's quarterly, we divide the 15.5 by 4. So that's what is going on here. And we get that the rate is 3.875% per quarter, and 1.038754 raised to the fourth power times $1. Again, there's an error right here. That should be raised to the fourth power, is $1.1642, or an EAR of 16.42%. So if we were lending, in other words, a savings account or some sort of CD, money market, we would want the rate that Bank B is offering. Now let's see what A is doing, because A is daily compounding. So there are 365 compounding periods in a year. And when that's the case, and again, there's an error here. This should be 365, 1.0004. So in other words, the daily rate, where the APR is 15%, the daily rate would be 0.0411%. So 4/100ths of a percent. 4 basis points would be another way of saying that, or actually 4.11 basis points. Nonetheless, when we do the math, that adds up to 1.1618, or 16.18%. So if we were lending, I would always pick Bank B because that has the highest EAR. If we were borrowing, I would want to go to Bank C because that has the lowest EAR. Of course, here's the answer from that. And then here is the actual formula that you would be using when you calculate that. Notice this is the error that was in those slides. It was missing that exponent. By the way, I should mention that unlike most slide decks from McGraw-Hill, this one is just riddled with errors. And if I miss them, like I did on this particular one, please bear with me. And if you have any doubts when you're reading something, you say, well, no, that's not right. I might have missed that one as well. Just shoot me an email. I'll take a look at it and see if it's an error. I have found some pretty egregious errors in this slide deck. That's really unacceptable. All right. So another example, looking at EAR. So we've got a bank that is offering a 12% compounded quarterly APR. And if we put $100 into it, how much will we have at the end of 1 year? What's the EAR, and how much will we have at the end of 2 years? Well, these are fairly simple questions. First, we have to get the periodic rate. In this case, the quarterly rate is 12 divided by 4 is 3%. And then, so we're taking our $100, we're investing it for 4 quarters at 3% per quarter. And that is 1.03 raised to the fourth times our $100. And that gives us $112.55. So our EAR is actually 12.55%. Since this is 1 year, it's a really easy one to calculate. Now, if we do that for 1 more year, what would we have? Well, we could easily do that. We would look at 1.03 raised to the 8th times the amount that we initially invested, and we end up with $126.68. So we're getting quite a bit more interest on the interest. If you'll note that back in year 1, we got an extra $12.55. So here we're getting an additional, what is that? An additional $14 and some change. All right. EARs and APRs, I already think I've mentioned pretty much everything on this slide. Just be very careful if you actually are taking out a loan that you understand what you're signing. And like I said, the forms and the information that you are that's made available to you is required by law to be made available to you is not the full story. And that's really unfortunate. It's been that way for decades too. If we look at compounding and the effect of compounding on a particular APR, if we were to start with a APR of 10%, remember, 1 year compounding, annual compounding, APR and EAR are identical. APR equals EAR for 1 year compounding periods. Right? So we have an APR of 10%, and if we don't compound during the year, then the EAR is also 10%. If we have quarterly compounding, that goes up by 0.38% or 38 basis points. If we do it monthly, it goes up to almost 0.5, almost 0.5%. If we do weekly, that goes up even higher, a little over 0.5%. Daily, notice that this is slowing down though, right? The yearly to quarterly, we had a big jump, and then quarterly to monthly, a little bit smaller. Monthly to weekly, smaller yet. Weekly to daily, even smaller. Daily to hourly, smaller still. And almost no difference between hourly and by the minute. We could do it by the second. And in fact, we could also do it continuous time. In other words, instantaneously. It's always compounding. And there we use the exponential, e raised to the q, and q is the quoted rate. E raised to the q minus 1 gives us the EAR of continuous time compounding. Back in the bad old days of the last century, there were caps on interest rates. And for instance, S&Ls, those are things that were known as savings and loans. They were financial institutions. And what you would do is you would go down with your money and you would open a savings account. And then if you wanted to buy a house, you would go down to that same institution and you would borrow money for 30 years. All was working well until the government removed the caps and deregulated the financial sector. This happened under Reagan. That caused the S&Ls to go bankrupt and fail on a fairly widespread basis and cost the taxpayers billions and billions of dollars to bail out. It was a total disaster and quite a mess. But let's back up a little bit from that story. At the time the caps prevailed, they were capped out at paying 5.5%, whereas a regular commercial bank could only pay 5.25%. The idea here was that they wanted to create some sort of extra advantage, competitive advantage for S&Ls because they were really for families and individuals, whereas the commercial banks were really for companies. And that is still the case today. Dirty little secret. You should be putting your money into a credit union. Now, not just any credit union. Do your due diligence and look at their financials. How long have they been around? How much do they have in the way of assets and so forth? How well are they run? That varies from credit union to credit union. But I've been banking with a credit union since the mid-'80s. And credit unions are a great way to work with a financial institution if you're an individual. If you're a company, you want a commercial bank. Commercial banks do a lot of advertising claiming to be a bank or a financial institution for the individuals. They are not. Forget the advertising. It's all, it's not true. They are there for the corporations and other major institutions, financial institutions. Credit unions are the way to go. And they also typically, a credit union is owned by its account holders. So in other words, any profit gets plowed back into the credit union. Back to the story here. So S&Ls, they were paying 5.5% and banks were paying 5.25%. What the law did not regulate was the compounding. So what you could do is if you did daily compounding, you could actually make your 5.25 return much higher. In fact, here the example is continuous time compounding, and they were actually able to get to almost 5.4%. So very close to what the S&Ls were legally limited to. Now, of course, the S&Ls could have done compounding like this too. And of course that, the amount of compounding that they would do would be based upon the competition, right? What are the other S&Ls doing? If they're compounding, then you would want to compound on a weekly or daily or continuous time basis. That would raise up the 5.5% to a higher level as well. So, in fact, here's the figure right here. They could have actually gotten up to 5.65%. Now we're going to get into different types of loans. So the first type that we're going to talk about is known as a pure discount loan. It's also known by a different name, zero coupon bonds. Zero coupons simply meaning they don't pay a coupon. You buy at a discount to the face value, and at the term, at the end of the bond or the life of the instrument, you get back the face value. All right? Very simple, very few transactions. That's why they're very popular, especially for short term. Anything under a year is typically a pure discount or a zero coupon. You can have zeros that extend out to 5, 10, 15, even 30 years because people will take long-term treasury instruments and strip the coupons off of them and create a whole series of zero coupons. But that's a deeper dive than we need to go here. You don't worry about that if that doesn't make any sense to you. That's for a later class. All right, so here's an example. Suppose that a borrower was able to repay $25,000 in 5 years. If we act as the lender and the wanted 12% interest rate on the loan, how much would you be willing to lend? Put another way, what value would we assign to $25,000 to be repaid in 5 years? So if the rate is 12%, what we're going to do is get our present value discount factor, 1.12 raised to the fifth, and we're going to divide our 25,000 by that, and there we go. That's $14,185 today, if in 5 years the borrower pays back 25,000, and that would yield a 12% return to the lender. If you wanted to check that out on a calculator, we can very easily do that. Clear our work. And so we have 25,000 as our future value, zero out the payment, and we've got 12%, and we have 5 years, and we compute our PV, 14,185.67. There we go. Treasury bills are a great example of discount instruments. And so all Treasury bills are discount instruments. And that means that they are sold at a discount to the face. So if, for example, the rate it's a 12-month T-bill with a rate of 7% on it, then we're simply taking the 10,000, which is the face on it, divided by 1.07. And so that would sell today for $93.45.79, and then 1 year later the government would pay us back $10,000. That would be the return of the principal, the $93.45.79, and a 10% a 7% return on that $93.45. Another type of loan would be a loan very much like what corporate bonds are. So a typical corporate bond, a debenture, is an interest-only loan. So the company is only paying interest during the life of the loan. So they borrow $1 million, they pay interest every whatever frequency. Sometimes it's semi-annual, sometimes it's quarterly, and they pay interest over that period. And then at the end of the loan, the maturity date, which is usually 10, 20, even 30 years from now, they will repay the principal. So here's an example. So we have an interest-only loan of $1,000, and the rate on that is 10%. So every year, the borrower would pay $100 to the lender. And then at the end of the period, the borrower would pay the final $100 plus the principal repayment of $1,000. Now we're going to jump into the type of loan that you may be familiar with. These are loans that you and I would get if we bought a car on credit, if we bought a house on credit. These are called amortized loans. And so what we're doing is, what amortization means very simply is that part of the payment is going to pay for interest and another part of the payment is going to pay for principal. So what we have here, for example, we've got a $5,000 loan with 5 years maturity and 9% is the rate. So what's going to happen in year one? Well, we have a $5,000 balance at the beginning, and at the end of the year one, it's still $5,000. We are going to pay the amount of the interest, which is $450. That's 0.09 times 5,000, right? 0.09 times the $5,000 principal of the loan. And we're going to pay down $1,000 on the principal. So we have a total payment of $1,450. Now, that $1,000 principal repayment now reduces the principal for the next period down to $4,000. So now we start the next period with only $4,000 borrowed. We're going to owe $360 on that. That would be 0.09 times 4,000 is $360. We're still going to pay back $1,000 again. So our total payment is $1,360. And at the end of that year, we only owe $3,000. And we keep doing that until the very last year we have a balance of only $1,000. And so 0.09 times that is $90 times that $1,000. And then we pay back the final $1,000. So our total payment is $1,090. And at the end of 5 years, we paid back the entire balance of the loan plus all of the interest that was owed. So that's an amortized loan. Now, that's probably not the type of amortization that you might get if you were to buy a house or to buy a car. What's the difference? If you said that your payment is the same every period, you'd be right. This payment, notice how it changes from period to period. They've got a constant repayment of principal, but the payment itself changes. There's another type of loan that's an amortized loan where we actually pay a constant payment. And so every period, it's the same payment. If we were to do this with, again, that same $5,000 loan, 9% for 5 years, our payment would be $1,285.46. So we'd make 5 payments of $1,285.46. By the end of the 5th year, and that last payment, we would have paid back all of the interest and all of the principal. So if we go on to the next slide, we have a table that shows all of the balances here over the course of the entire 5 years. Here's our first payment. Here is that interest, and then this would be the principal, which is the payment minus the interest. And then we subtract that principal paid from the beginning balance, and that leaves us with $4164.54. And of course, that becomes our starting principal, or our starting balance, beginning balance at the beginning of year 2, and so forth down the line. We see, obviously, at the end of the loan, the entire balance has been paid off. So there's the $5,000. And then the $1,427 is our total interest, and then total payments would be $64.27. All right. Another type of amortization that gets done is a little more problematic. This type of loan is a potentially a much higher risk loan because it's only partially amortized. So the basic premise here is that we're going to create a payment as though it were amortized over a longer window, but we're going to make the maturity of the loan much shorter. So here in this example, they say, well, let's look at a 5-year loan. So the maturity date is 5 years, but we're going to calculate a payment based upon a 15-year amortization. And so that means that at the end of 5 years, we're still going to have some balance due. There's still a large chunk of principal due. And it actually turns out that it's considerably more than one might think. You might think, well, gee, it would be 2/3 of the principal, right? Because we're 1/3 of the way through the loan, so only 2/3 is left. But actually, it turns out, no, it's considerably more than 2/3 of the principal still outstanding. So in this, they give us a slightly different example here with some real numbers that we can play with. So let's look at this one. We have a $100,000 mortgage, 12% APR, that's 1% per month. We're compounding monthly, and we're going to amortize it over a 20-year window. All right. However, the actual term on the loan is 5 years. So at the end of year 5, whatever is left due becomes a balloon payment. All right. And so let's calculate the size of that balloon payment. Remember, we're 1/4 of the way through the loan, but what we're going to find is that the principal still due at the end of year 5 is considerably more than 3/4 of the loan balance, the original loan balance. So here they're showing, let's calculate the payment. So the monthly payment on this would be $1,101.09. Right, so we can do that on our calculator here, and so we have 100,000, and that is going to be our principal, and we're borrowing that, so that's a cash inflow. We're going to clear out the future value. We're going to have 240 months. We have an interest rate of 1% per period because this is monthly, APR of 12. And we're going to compute the payment, and there's our $1,101 and 9 cents. And I apologize. My iPad is not playing nice with the formatting here on this calculator, but you can see enough of the figures that you can tell that this is 1101.08. All right, so there's that payment that we had. Now, how do we figure out what's still due? Well, we know what the payment is for a 20-year amortized loan. So there's a very simple, actually quick way of figuring that out. If we were to, and let's do this on a timeline so that you can better see this. So we are right here. Oops. We are right there on the timeline. So this is today, this is 5 years out, and then we've got 10, and then here's 20 years out. So we're right there. We have remaining on the loan 15 years, right? And we know that the payment is 1101.09 per period. So we have how many periods left? Well, 240. That's the original, that 20 years. 5 years is 60 months, so subtract that from the 240. So we have 180 months left where we still would be paying 1101.09. So the simple way to figure out what's due is to take that payment and figure out what the present value of it is over the 180-month period. So let's do that. We're going to use the same rate. We're going to change n to 180. And then we are going to, we already have the payment in there, but let me just put it in again to make sure that it's nice and clean. 0.09, there's our payment, and I'm going to compute the present value, $91,700 and about $45. So, and let's see, they 91,745 or 44 and some change. All right. So that's considerably more principal than one might think for being a quarter of the way through the loan. Let me give you yet another example that might make you worry even more about this. And this is not a partially amortized loan. This is a fully amortized loan. So we're going back to that first type of amortized loan where we fully amortize it and the maturity date is the end of the amortization period. So I put together a little spreadsheet here for you. And where did it go? It was open there just a moment ago, and it seems to have disappeared on me. Don't know why. There we go. All right. So what I have here is an amortization schedule, and I've done it based upon two different terms. One is the very classic 30-year mortgage. That's something that if you're buying a house, more than likely you're going to be looking at a 30-year mortgage. But I've got it, so that's right. That's over here in column C. In fact, let me get my highlighter out. Right here is the 30-year mortgage. But I've also recalculated that and done this as a 15-year mortgage, which I show over here. So we've got a amount borrowed of $200,000, and I'm assuming a 7% rate, which is pretty much what today's rates are, somewhere in that vicinity, not far off. And we're going to do this on a monthly compounding basis. So you'll notice here in the first period, the starting balance is the $200,000. We have I've calculated the payment in this 30-year loan to be $1,330.60. So every month, that's your payment for the house. Of that $1,330.60, $1,166.67 is your interest payment. So that only leaves $163.94 to go towards principal. So that we apply that to the principal, and now our new principal is $199,836.06. And we do the same calculation using the 7% divided by 12. That's our monthly rate. And so our interest payment drops by almost $1. So that means that what's left to pay down principal goes up by almost $1. And we keep iterating. And I've got this run out all the way through 360 months. And just to prove to you that it actually comes to a zero balance, notice that our final payment covers the last bit of interest, plus it pays off that remaining balance right there. So we're at month 360, we're completely done with this loan. Now, the other thing that I've done here is I have added up all of the interest payments, and that comes up to a grand total of almost $280,000. Remember, we only borrowed $200,000, but we have paid it off over 30 years. So the interest is actually considerably higher, 40% higher than the actual, or 40% above the actual amount borrowed. We only borrowed $200, but we paid $280 in interest. So our total payments are $480,000 for something that we only borrowed, less than half of that. Now, compare that to paying off the mortgage in 15 years. Now, I've calculated the new payment. And that new payment is $1,797.66, or almost $1,800. So you might say, well, gee, that's $500, almost $500 more per month, and you're absolutely right there. And that's not an inconsequential amount of money, but look at this. I do that same amortization table. I've got a beginning balance of $200. I have a payment of $1,800. That interest, of course, at least initially, is identical to the 30-year in the first month. The second and third months, it all changes, but the first month, it's the same. And when we subtract that from our payment of $1,797, we actually end up with $630, almost $31 going towards reducing the principal, the outstanding balance. So our new balance at the beginning of the second month is only $199,369, which means our interest there is less by about $3 than the 30-year loan. And then the rest of the payment goes towards reducing the balance even further by $634. Let me get to the punchline here, and that is I also added up all of the interest that we pay, and it comes out to be $123,000. Compare that to almost $280,000 versus $120,000. Nearly $160,000 less that you pay out, and your mortgage is over in 15 years. That's an incredible difference between these two. Now, and I know this is a corporate finance class. This is really more about corporations, but let me just throw out a little piece of advice from a personal finance perspective. You might not want to get a 15-year mortgage, and that's understandable. You're probably starting off with a lower salary and you want to get more house or as much house as you possibly can for your money and that sort of thing. I understand that. One thing, a kind of a financial trick, if you will, is go ahead and get the 30-year mortgage, but make a payment as though you were paying off a 15-year mortgage. So get the 30-year mortgage and your payment is that $130. Let me just change the color of my marker here. Your payment is that $130, $1,330, and you're going to pay, though, instead of the $1,330, you're going to be paying $1,800 per month. And if there's a month that you can't pay it, that's fine. But ultimately, if you pay the $1,800, and there should be no additional charge from your bank to do that, there no longer on mortgages are there early or prepayment penalties. That got erased, thank goodness. That was that at one point in time that was the case. Now that's not the case. So you can always pay down the loan early with no penalty. But if you pay that $1,800 instead of the $1,330, you will pay off your mortgage in 15 years. The beauty of having a 30-year and making a payment as though it was a 15-year is that if you did have a month or you had a period of time when maybe finances were rough, maybe you had additional expenses, then you could revert back to paying the $1,330. You still would have to pay the $1,330 no matter what, even if you paid down the principal ahead of time. And especially early on in the loan, the sooner you make that paid, the sooner you can reduce that balance, the better off you are. So even if that only works for you for the first couple of years, you've paid off a lot of the balance of your loan. So you've still saved yourself thousands, maybe even tens of thousands of dollars, if not the entire $160,000. So just a little extra piece of personal finance advice here. But this amortization table really dramatizes how much money we end up paying if we just go with the typical 30-year loan. It's not a very good idea, I promise you. So we're done with this chapter, and next chapter is chapter 7. I will see you at that point. And if you have any questions about this material, please make sure that you get in touch with me and send me an email so that we can set up a Zoom session or possibly meet face to face. Have a good evening. Thank you.